What is going on, investors? Hopefully guys are doing well out there. Time to look at another sector. Now, we're not looking at the chip sector or the tech stock sector. We're going to bounce around a little bit. Couple of different stocks, and what I call these is kind of the hype stocks. And a lot of the hype has been kind of drained out a lot of these names. And some of you are going to be like, is this guy insane? Actually getting on here and looking at stocks that are down 50, 60, 70, 80% over the last year? Well, no, the people that were insane were the ones that are recommending you buy these stocks when they were 60, 70, 80% higher. And a lot of them didn't go through the earnings, didn't look at the revenue, didn't look at the balance sheet, didn't look at the cash flows, and in a lot of cases didn't even look at the technicals on the stock chart. I tell you what, as we go through the 4 stocks that I have lined up today, we're going to have Palantir, we're going to look at Teladoc Health, we're going to look at Roblox, and we're also going to look at DraftKings. Some of the things are starting to line up with a lot of these companies. Now, there will be timestamps down in the description below if you want to bounce around to the stock that interests you. But a couple of caveats with these. Obviously, these are high risk, high reward type stocks. And look, that's the stock market in general. You can't take risk and not expect any reward on the other end. And so, look, you've got to take a little risk every once in a while to get that high reward. And just as my experience as an investor for over 20 years, some of my best investments, yes, my long-term holds, the Apples, the Googles, the Amazons, the Microsofts, the Nikes, those have been wonderful investments for me over the long term, but I have not realized any profit for those because I continue to believe that into the future, those will continue to grow and be great investments. The actual stocks that I've taken a lot of profit on over the years are somewhat speculative bets that I've analyzed very deeply and looked at the cash flows, looked at the financials, and then timed it relatively correctly when it came to a technical perspective. And boy, you can have massive gains on this one. Now, I will repeat with all of these stocks, I don't consider any of them buy and hold stocks at the moment. Some of them certainly could turn into that. Quite frankly, all 4 of these stocks could turn into buy and hold type stocks. I don't think we'll mention them in the same breath as like an Amazon or a Google, like some people have here on YouTube, but I still think some of these stocks could return high rewards for investors over the next couple of years. But if I invest in any of these stocks, and full disclosure, I don't own any of these stocks at the current time, but I would take profits on these types of stocks. Doesn't necessarily mean you need to take profits on the whole position, but let's assume you buy 100 shares of one of these companies and it goes up 20 or 30%. Look, it could happen in a month or 2 months or a quarter. You take profits at least on a portion of that. And then also with these as well, this is certainly a lesson to anybody that bought these stocks at a much higher price. You've got to stop your losses on these ones. You got to cut your losses. But I would say with the vast majority of these stocks, a lot of the losses have been drained out of this. When we look at Teladoc Health, I tell you what, that company is on a rock bottom type valuation based on their revenues. Now, careful on your sizing as well. Sometimes I get comments here on the channel where somebody says, Palantir is half of my portfolio, or Teladoc Health was 30% of my portfolio. And I just want to cringe and curl up and start crying. These stocks should be 1%, 2% of your total allocation. If you don't have allocation into an S&P 500 index fund, a NASDAQ type index fund, or the individual stocks that make up the bulk of those funds, which we talk about regularly here on the channel, the Amazons, the Apples, the Googles, the Microsofts, if you don't have allocation either into an ETF, which broadly holds those stocks, or those individual stocks themselves, well, you need to start there. This is, in my opinion, more for the advanced investor that wants to add a little risk to their portfolio, hopefully time it relatively correctly, have a huge run up over the next, we'll call it 12 months, and then maybe cash out and go get a vacation, go buy a watch, go buy something nice for their kids or their wife. That's how I view these stocks, is these are my money stocks. This is where I put a little bit of money in, and if it works out, I cash out into some kind of physical asset or maybe like a vacation for my family, and we create memories or create an heirloom that we can pass down to our family and our children. That's how I view these stocks, at least in the shorter term. Maybe they eventually turn into buy and hold stocks. Now, The first stock that we're going to talk about on today's show is Palantir Technologies, probably one of the most pumped stocks here on YouTube. But when you come over here and look at the earnings estimates, what you'll notice is Wall Street doesn't give a crap about this stock. And this is one hint to you when, look, the market's going to go through a rough patch. We're definitely in a bear market. It could get even worse over the next couple of months and weeks, but at some point it's going to turn back around and you're going to have the return of a bull market. One hint that a stock is being overhyped by either the Motley Fool type websites, the Seeking Alpha type websites, and certainly here on YouTube as well, and certainly Twitter and other places where they get in Wall Street Bets and Reddit is probably another example. Some stocks just get swept up by kind of the retail hype crowd. One way to tell that it's overhyped is the number of analysts. You can come to a site like Seeking Alpha and see the number of professional analysts that are analyzing a stock. And I tell you what, when you look at the Googles and the Microsofts and the Apples, they have 30, 40, 50 analysts covering those stocks. You come over here at Palantir and there's just 9 analysts covering this stock. That just lets you know that basically nobody cares about this stock. But we will look at the financials on this stock, and it has sensational gross margins and it has solid revenue growth. Those are two of the biggest check boxes that I check when I'm looking at kind of a high risk, high reward stock. It's got to have high gross margins and a relatively high growth rate. If you check those boxes and things continue to progress with this company, well, I tell you what, you've probably got a winning investment, at least in the longer term. Now, year to date, this stock's got hammered, down 58%. Over the last year, this thing is down 72%. People are crying if they bought this one at a higher price. Now, we've done a more full video on Palantir. In fact, we cover this stock every quarter. I'm probably one of the few people here on YouTube that have been negative this stock for a very long time. When we looked at the financials, we still have a pretty hefty valuation on this one at $16 billion. But I remember looking at this stock when it was like 30 or $40 billion, which was north of like 30 or 40 times forward revenue estimates. And it was absolutely insane. But we're starting to pull back a little bit and it's starting to make a little more sense. Now, this is not going to be a cheap stock in the shorter term. You still have a price to earnings ratio, which is in the stratosphere. You still have a price to sales ratio that is kind of in that 15 to 16 multiple. And that's certainly on the expensive side, but look, it's not 30 or 40 like it once did. Now, since the last earnings, there actually hasn't been a lot of press releases out of Palantir, and that's not necessarily a good thing. They announced that they are going to partner with Beckett Collectibles, a website actually I am very familiar with. In fact, I have a website in the sports trading card space that actually took a lot of traffic and actually inspired Beckett to actually change a lot of the ways that they are presenting information on their website. Believe it or not, a lot of the ways they present their information on Beckett website is actually inspired by the way that I presented the sports card information. So they're going to partner with Beckett. Now, the reason why I'm bringing this up is Beckett's not a particularly large business. This is not going to be a deal that you're going to recognize when we come over here to the financials. It's not going to tick it up any significant degree. But what this is showing you is that actually Palantir's technology and their foundry service can actually flow downstream. It doesn't have to be like Fortune 100 or even Fortune 500 type companies. Beckett's a relatively small company. I mean, the fact that I can set up a website in basically my basement and compete with a site like this just shows you it's not that big of a business. I think it's probably annual revenue is somewhere, 15 to $20 million. That's a relatively small business. But what that shows you is that Palantir's foundry model is not only meant for the top, like Fortune 100, Fortune 500, or even governments and things like that. Well, it actually can flow all the way down to kind of a mid-market or a small business. And that can be a relatively large business overall, because you think about like Meta, their biggest customer is small business. You think about Microsoft, their bread and butter business is enterprise, but they also obviously sell a lot to consumers and rely a lot on the average small business or small consumer. You look at every big company that we look at here on the channel, They rely on the top enterprise client, but they flow all the way down also to just the end user, just the single mom and dad, if you will, using their product as well. So if Palantir can actually expand into a service and a product that has a broad use case across small and large business, I actually think that's a positive, and that is a sign with this Beckett Collective deal. Now, when we look at this company from a forward revenue estimates, you could look at earnings, but they are paltry. And also, some of you might notice here on the channel, I don't talk about EPS a lot, especially from a forward basis. We don't look at the forward estimates because when you look at companies and when they report, the EPS is the one metric that is often companies miss on the largest amount. Where you want to focus, I actually think, is revenues, because we'll be able to come over here to the financials and see how they're scaling up from a year-to-year basis. And we'll be able to see, like, okay, what do we think the operating expenses are going to be? And also the COGS, or the cost of revenue, or the cost of goods, is going to be in the upcoming quarter and maybe the subsequent quarters. So we actually can estimate that and then come down to kind of an operating profit, or all the way down to net income if we wanted to on our own as investors. We don't have to rely on analyst estimates. What I do like, though, is revenue estimates. They tend to be relatively accurate. And with Palantir, we're looking at kind of a 20% grower into the future with this one. I tell you what, they are going to double this business very quickly. And yes, the valuation on this one is still relatively high at about $16 billion. But if you start looking out a year or 2 years, if you can continue to grow your business at that 20% clip, we'll switch these over. So on Seeking Alpha, you can look at quarterly revenue estimates, and then you can flip them over to annually. Obviously, you can add up the quarterly ones if you wanted to. But what you can look at here is 2 years out into the end of 2024, you're going to be at almost $3 billion worth of revenue. If you can grow in this kind of low to mid 20% rate, that would put you at a price to sales multiple at just 5.5. Right now, you're trading at about 8.5 times sales. So you start looking out into the future. If you believe this growth rate, you believe these revenue estimates, a 5 times sales multiple on a company that has these types of gross margins. And then also, what's the growth rate after 2024? That's probably the biggest question, because look, 5 times sales is still relatively rich. It doesn't really matter what kind of company you're looking at. But if this company can maintain a 20% growth rate, well, all of a sudden that 5 times sales 3, 4, 5 years out is a relatively decent valuation. Now, the complication with Palantir, as most of you know, is the fact that this company doesn't make money. They have excessive stock-based compensation, and that dilutes you as the common shareholder. You see, over the last year, you had about 1.9 weighted outstanding shares, now all the way up to 2, although that's slowed down a little bit. In fact, what we've looked at this company in the past. Now, again, links in the description below to our exclusive videos, our kind of videos that we do right after earnings. We've already covered a lot of this information here on the channel in the Palantir video that I posted after this company reported these earnings. But I do want to highlight a couple of things, some of the reasons why I'm still interested in this stock. Again, I don't own this stock yet, but there's some things to like here. So we had pretty solid revenue growth year over year. The reason why we continue to follow this stock is off of $473 million worth of revenue. You only have $102 million worth of costs. That leaves you gross profit of $370 million. Another reason why I kind of like this stock a little bit more now than I did a year ago is the fact that our operating expenses are starting to flatten out. Notice our sales and marketing, despite the pretty you bolted on over $100 million worth of revenue. Look at your sales and marketing. It's basically flat. It went from 162 up to just 168, or closer to 169. Your research and development actually went down. It went from 110 down to 88 million, and your general administrative also went down from 157 down to 155. You add all of that up, our total operating expenses actually went down from 430 million down to $412 million. I am really liking this. Now, when we come over here and look back at the quarterly estimate for the upcoming quarter, revenues are expected to come in at $474 million. So essentially a flat quarter over quarter. That will represent 21% growth year over year if they come right in on that number. So if Palantir, I don't know on a quarter over quarter basis if they're going to drive flat operating expenses or if they're going to actually continue to trend down, but you are going to remain at just kind of marginally unprofitable at this company. So off of $473 million worth of revenue, they had $370 million worth of gross profit. You minus off $412 million worth of operating expenses, and you lost about $41 million. And I know that still sucks, but last year you lost over $146 million. And you notice this company's actually on that kind of loss of $41 million. That's kind of the run rate this company is on, because you see over the last 6 months, they've lost $81 million. That's essentially $41 million times 2. So the way this company is able to improve that, if they can continue to drive down operating expenses, obviously that would increase profitability. If they can somehow drive down cost of revenue, that could increase gross profit. But obviously growing this top line is the most important thing over at Palantir. And this is a company that needs to bolt on another $40 million to this 474. So we're really looking all the way out into Q1. Again, if you believe they'll grow 20% this quarter, 17% in Q4, and 20% in Q1, if you get to $540 million, you will actually be profitable over at Palantir from a quarterly basis. Again, all things being equal, our cost of revenue remaining in line and our operating expenses remaining kind of in that 415, maybe as high as 420 in terms of those operating expenses, you actually are just 2 quarters away from spinning a profit at this company. Now, the profit is a little bit complicated because they have so much stock-based compensation over at this company, but it has gone down year over year on a quarterly basis. Last year, they did $232 million on that stock-based compensation. This year, down to $145. If they're able to keep that at that level and maybe even potentially drive it down a little bit more, certainly good from that perspective. Now, the other reason why we like this company is from a balance sheet perspective. This company has plenty of cash to kind of meet this runway of growth. They have plenty of cash. They've got a few $1 billion worth of cash. They have almost no liabilities. So this company has crystal clear sailing, at least from a cash perspective, to meet those revenue and those profit targets. Now, complicating the situation a little bit is the fact that they're using the stock quite a bit to compensate the employees. So that might have to be subbed out. You might be doing less stock-based compensation into the future and pulling more cash out of your pocket. But from an operating perspective, it will read about the same. Where it will change things a little bit is from a cash flow perspective, because as you know, if you're using stock-based compensation, you get to add that back in dollar for dollar on the cash flow statement. Now, you've got a 6-month net income figure of $280 million loss, but you get to add back in $295 million worth of stock-based compensation. And you see here, this company is actually cash flow positive on a 6-month basis to the tune of nearly $98 million. So we're cash flow positive when you factor in stock-based compensation and all your other little add backs and subtractions when it comes to that. They don't really have to invest in a lot of property, plant, and equipment. It's not like an Amazon or some of these other companies that we look at that have just gigantic expenses there. You have just basically $21 million there. And then from a financing expenses, not a whole lot. So it's actually a very clean company, very easy company to understand, and that what makes this somewhat intriguing, especially if they can start to turn a profit. And then quite frankly, forget the guys here on YouTube, but if it could catch the attention of Wall Street, get more analysts kind of covering this stock and getting a little more quote unquote hyped up about it, that certainly can be beneficial for this company. But what I am seeing is that this company could be potentially profitable as soon as the 4th quarter. And I think almost assuredly, unless they do really stupid stuff with their operating expenses, this company could be as profitable as soon as Q1 of next year. Now let's come over here and look at this from a technical perspective. Now, clearly it's a disaster chart. The longer term trend is basically down. The shorter term trend, every trend is down on this one. But when you come in here and zoom in a little bit, yes, we're making higher lows. That's why I'm not in on this stock right at the certain moment, because this trend is not reversed. You also have an area of resistance right here. I have this red line. I'm going to change it to purple just so you know which one we're talking about. We'll even make it a little bit thicker. There's this purple line here that's pretty heavy resistance on this stock up here at about $9.30 per share. I tell you what, in the shorter term, unless the market does a big dump again next week, it obviously had a really rough week last week, and if you follow through with this, you got a lot of selling. Well, my guess is this stock is going to dump out the bottom here and probably at the very least retest the 52-week lows that we have closer to about $6.50. But I tell you what, you dump down below $6.50, who knows where this one is going. But if people cool off a little bit, momentum stays in this market, quite frankly, this one pretty comfortably could go from $7 up to this resistance line up here at $9.50. Now, there's going to be two converging technical resistance points when we approach that kind of $9.50 level. You are going to have this $9.50 level, which again acted as support back here, resistance here. It basically danced on that $9.50 level for a while, and then you go back to the initial kind of, I think this one went public via SPAC. Well, it was $10 kind of originally, kind of hovered on that level and then just launched up into just crazy stratosphere type prices. Those prices aren't coming back anytime soon. If you bought this one at a higher price, forget about it. But we are going to converge at $9.50, and that is going to create heavy resistance up here. I think the high probability is you get rejected again at that price, but you could come back and make another series of higher lows. The exciting part for me with Palantir is the eventual push, and again, maybe it doesn't happen, but the push above $9.50. I actually like this stock actually at that level, because at that point, the $9.50, instead of being resistance, will now be support. And then you have all this area above the $9.50 level where, yes, people have accumulated this stock. There will be people that will get out of this stock as soon as it gets back into these levels. But I'd rather buy this stock at this higher level with my stop and my risk kind of capped at that $9.50 level. And then you basically, at that point too, the momentum will be back in this stock, okay? You'll have taken out this level. You potentially maybe even taken out that level. And so now you're playing kind of that upside momentum with Palantir. Whereas if you buy this one now, the only thing that makes a little bit of sense is buying it here at this current price, playing it up to $9.50, and then probably peeling off on that on a shorter term trade. In that case, I'd have a stop loss set at the lowest level down here at the 52-week lows, right down at $6.50. That's not a strong risk reward where you're risking $2 or $3 to the downside to make $2 or $3 to the upside. Doesn't make a lot of sense. In that case, I think you'd want to push your stop loss really tight, maybe up here to about $7 per share. Then you're getting less than $1 downside and over $2 to the upside. That's the kind of risk reward that I'd want to take in the shorter term. But me personally, what I'm going to do is I'm going to wait till earnings over at Palantir. You're not getting earnings on this one until November 17th. I will wait until those earnings appear. Potentially, investors start to realize that this company is on the doorstep of finally being profitable. And if they can give positive guidance and kind of positive momentum out into the future on this one, well, I think the momentum could carry this one up over the $10 share price. And that's where you could get some strong momentum from a technical perspective, strong momentum from a fundamental perspective, and then strong momentum from investors starting to look out into the future saying, hey, this company has finally turned the corner. It's safe to come into this type of stock. Those are my view on Palantir. Again, we have earnings coming up on this one, right? It's not a for certain date, but probably about still 2 months away on this one. So you've got plenty of time. Put this one in your watch list, monitor a little bit, see what happens. I tell you what, the momentum gets back in this stock. This one could run considerable. Next stock that we're going to look at here on the channel is Teladoc Health. Now, those of you that have been watching the channel for any length of time know I've just obliterated this stock every time we've looked at it. But more recently, things are starting to look a little bit better over this stock. What's looking a lot better to me is you've got just a $4.9 billion valuation. Folks, that was over 5 times higher over the last 52 weeks when this stock was over $150 per share. That's 5 times higher. So this stock was north of a $25 billion valuation, which was just insane. And we told you that here on the channel. We told it to you multiple times, and I told it to you forcefully to hopefully get you to realize that this stock had a high probability of doing exactly what it's done over the last year, down 77%, year to date down 67%. This thing has just gotten obliterated. Now, what's interesting about this stock is the fact that about 2 years ago, this company finalized a deal to buy Livongo Health, and they closed that deal in just 3 months. That was an $18.5 billion valuation. So obviously Teladoc at that time was probably a $40 billion stock, and it bought Livongo Health at $18.5 billion. Let me remind you, I just told you this. This company, the total company, Teladoc and Livongo, are now worth less than $5 billion. So I tell you what, that to me just screams that value is finally here when it comes to Teladoc Health. Now, some of the ways that we're going to know that is the fact you are seeing some competition kind of drain out of this space. Amazon shut down their competing service. I wouldn't even call it a competing service. Amazon had just a couple of customers, and most of the customers said they had no use for the product. Now, what we're also though seeing is Amazon and CVS Health and Walgreens, these companies are on a buying spree. They're seeing the massive declines. Okay, it's not just Teladoc that has been down over the last year in the healthcare space. There's a ton of stocks that are down big, and Amazon is going on a buying spree, CVS, Walgreens. That certainly brings up the fact that Teladoc is certainly an acquisition target on its own now. The fact that now you have just a $5 billion valuation, the fact that this is Livongo Health and Teladoc, again, both companies were worth well in excess of $18 billion just a year or two ago. And yes, they were wildly overvalued at that time, and this company wildly overpaid for Livongo Health, but now the price has just been drained so much that you've got to take a look at this one. Now, in terms of the revenues, look, you still have really strong revenues over at this company. In the most recent quarter, $592 million. That represents 17% growth. It did beat expectations as well. They gave guidance for the upcoming quarter between $600 million and up to $620 million. Consensus was for $618. This is a pretty wide spread on that revenue estimates, like a $20 million spread. If they come at the high end, they will beat the consensus estimate by a little bit. If they come to the low end, they actually miss it quite a bit. So let's come over here and see where Wall Street has pretty low expectations on this one. And notice you do have a fair amount of analyst coverage on this one, nearly 23 analysts covering this stock. You've got a $608 million revenue estimate. So I just want to remind you, so we've got earnings with Teladoc Health coming up. We're still a little ways away. You're a little over a month away. I've got October 26th as the approximate date for those earnings results. I just want to remind you that the estimate is going to be right around $608 million. Again, guidance was between $600 million and up to $620. The original consensus estimate was $618. And so now that has been revised down to $608 million. So when Teladoc finally announces their revenues in about a month, if they come close to 618, just understand that is going on a press release, that is going to beat the revenue estimate. But just understand that is a revenue estimate that actually came down over the previous quarter. So just understand that when you see companies beat and people celebrate, well, did they beat the original estimate, or did they beat the estimate that came in over the course of the 3 months when they reported their last earnings? Again, we are actually going to see this a lot, I think, over the next 12 months in the stock market. Revenue estimates are going to get pulled in, and then stocks are going to quote unquote beat it on that top line of the press release, but they're really just coming back or coming close to the original estimate that was a little bit higher before, obviously, they got pulled back. But what I like about this company is the fact that you've got a price to sales multiple that is not ridiculous on this one, and you have a multiple on this growth rate as well. You've got kind of a mid-teens grower out essentially into infinity, and you have a lot of analysts covering this stock, and you've got a pretty solid growth rate on this one. Again, from a yearly perspective, on this company, you're looking to do $2.4 billion worth of revenue at the end of this year. You're paying just 2 times sales on this one. We looked at Amazon. They just acquired a company in this space in excess of 2 times sales. And then you look out into next year, if you grow 15% next year, you're paying just 1.7 times sales for this company. This company is certainly going to be looked at from an acquisition perspective. Now, from a financial perspective, there are some things actually to like here, but it's really complicated. And like the other videos and other stocks that we're looking at today, I've done a more extensive video on these financials. I'll include a link to that in the description below. You're more than welcome to go to that video and see a more in-depth thing. But I want to point out the main thing to understand with Teladoc, so you don't even have to go look at that video if you don't want to. In the most recent quarter, you had $592 million worth of revenue. Now, their cost of revenue are soaring. Their advertising and marketing spend is soaring. Their sales flattened out. Their technology flattened out. Their general administrative flattened out. So we're seeing some costs actually start to flatten out, and I think that's a good thing. But you flowed all the way down here to loss from operations, and it was a gigantic $3.1 billion, which is just insane considering, again, this company has a $4.9 billion valuation, and they just posted a quarter where they lost nearly $3.1 billion. That compares to just $79 million loss in the previous period. But it's a little bit complicated because they had to take a goodwill impairment. So when Teladoc bought Livongo Health for over $18 billion, what they did to their financials is they come down here to the asset side. Now we're over here on the balance sheet. I'll go back to the profit and loss statement here in a moment. But what they do is they add a portion of that $18 billion to the goodwill segment of their balance sheet. And so you see here last year, at least in actually at the beginning of the year, December 31st, 2021, they had over $14.5 billion worth of goodwill. Now notice they had to shed off nearly 10 billion of that over the last year, because again, when your company's market cap goes down as much as it does, you can't carry on this goodwill. This is one of the reasons why here on the channel, we don't look at goodwill. I don't even factor this in. If I were to factor in this company's, so this is the asset side of a balance sheet, I would subtract, and this goes for every single company that I look at, not just Livongo Health. I would subtract the entire goodwill line from their total assets. So notice last year, they had over $17.7 billion worth of total assets. 14.5 billion of that was in actually goodwill. So the vast majority of that, and notice that all of that got peeled off. And so your total assets over the last year have been cut in half. This is why I would never, and I repeat, I would never value a company just straight on their balance sheet. And if they have if they have a lot of goodwill, I would discount that almost 100% off of that asset side. Now, I want to zoom back up here and show you, though, there's actually some interesting stuff going on with this company. The fact that they had to take that goodwill impairment in the most recent quarter, it was $3 billion. Again, this is an accounting measure. Now, it's not an excuse by this company paying $18.5 billion for Livongo. Clearly, they overpaid. If they would have waited, they could have gotten this for a song and a dance. But look, the past is the past. It's over. But they do have to make that accounting adjustment. And so they had to peel off $3 billion. Now, what you also have here, a pretty significant expense, is this depreciation and amortization that came in at about $60 million. Here's what I want to show you. The company lost in the most recent quarter basically $3.1 billion. If you take 60 million and you add it to a shade over 3 billion, you actually get to a number almost exactly $3.1 billion. So this company, minus the goodwill impairment and minus depreciation and amortization, again, that's a non-cash charge that you get to add back in on cash flows. I'll show you cash flows here in a second to kind of emphasize this point. This company's actually break even from a revenue and then just simply operating perspective. This company's actually break even. They're break even on the most recent quarter. They're also break even over the last 6 months as well. You notice this company over the last 6 months lost $9.7 billion. Again, that's just insane for a company that's worth like $4.5 billion. But again, the vast majority of those losses, $9.6 billion is a goodwill impairment, and another $118 million is depreciation and amortization. If you take 118 and plus $9.6 billion, you get to a number almost exactly $9.7 billion. So this company is actually break even from an operating perspective. And I would assume these goodwill impairments will start to slow down. In fact, they have to. They have just $4.8 billion worth of goodwill now. So I would expect those to slow down, and that will improve the financial results. Because look, there are some investors that don't understand this and don't pull up these financials and don't understand how goodwill impairments and depreciation work. And so they're thinking this company is in this dire shape where it's actually not that bad. Notice on the 6-month cash flow, this is going to emphasize that. So you had a gigantic $9.7 billion loss, but you get to add back in that goodwill impairment of 9.6. You get to add back in depreciation. You get to add back in stock-based compensation, which quite frankly, I wouldn't do, but look, they are able to do that here on cash flows. You get to positive cash flows over the most recent 6 months at $61 million. Last year, you were just at $34 million. So there are some things to like. Similar to Palantir, this company is actually right at the bottom of their loss years and kind of period. I actually think this company from an operating perspective could swing at least to a break even and potentially earn a profit from that perspective going forward. Now, again, we have earnings for this one on October 26th, and my advice on all 4 of these stocks is simply wait, put these on your watch list, monitor them. I would wait until we get to those revenue estimates and those earnings on the 26th, because what I want to see is if this company is able to achieve maybe an operating profit or just a very, very small loss. That would be interesting. The other thing that I think we need to confirm are these revenue estimates going forward. How did the most recent quarter come in? How are they guiding forward for the upcoming quarter? If all that checks out to kind of a mid-teens grower and this quarter is good, well, all of a sudden, I think you've got a stock that is absolutely turning a corner. And when you look at this one from a technical perspective, obviously, I mean, if you bought this stock at a higher price, you've been obliterated. You need to learn your lesson. Don't buy into the hype. When you pulled up, and some of you might say, well, how do I not buy into the hype? You could have, number one, you could have simply watched any of our videos that we've done on Teladoc. Number two, learned how to read these financials. And it's not that you need to learn every single line of these. You simply need to rely on revenue, your total expenses, and your losses from operations. Forget everything else. You don't need to look at net income. You don't need to look at interest expense. You don't need to even come down all the way to EPS. I don't do that. I stop simply here at operating profits, or in this case, losses from operations. That's all you need to do. And then learn a little bit about charts. I tell you what, when this one reversed, it was going to get ugly, and it got ugly quickly. But look, over the shorter term, this one's not looking too bad. I mean, we've been making higher lows since May on this one. It's not dramatic, but we're also confirming that with higher highs. Now, we didn't confirm it with the most recent run-up that we had in August, but here we are down here at about $30 per share. I tell you what, in the shorter term, I could see having a stop loss on the 52-week lows on this one, which is close to about $27 per share. Now, this is not a trade I would put on right at the moment because the upside I don't think is high enough, and the risk heading into earnings is relatively great, because this stock, like all of these stocks, could put up a stinker. You do have some resistance here. I'm zooming this out because I'm showing you there's significant resistance at this $38 price tag. But look, that's $7 higher on this one. So in some cases, maybe you could put on a trade like this where maybe you put a stop loss at these lows that we made back in June. That would put you at a stop loss right around $29 per share. That's only $1 lower than where you're at now. And I think you could play this one back up to that resistance at 35. That's $5 an upside with about $1.50 downside. That's the kind of risk reward. If you're going to play with risky stocks, you should have like 3, 4, 5 times upside. And that's not all the way up to the top of the channel. When I say I would start maybe peeling off my profits at 35, but I would let at least a portion of it run, because at some point, maybe the momentum carries you back to higher highs. If you go back to higher highs, you're coming north of $40 on this one. And what's interesting about Teladoc Health is the fact that you have that relatively low valuation that could keep a floor underneath this stock, as some other company, Amazon particularly, maybe even CVS and Walgreens, as they continue to do M&A. This certainly can be a stock that they look at because, like we said, they've taken the goodwill impairments over at this company. They are about to be break even from an operating perspective. That is very attractive from an M&A perspective, because Amazon could come in here and and see that this company does $51 million worth of stock-based compensation in the most recent quarter. Instead of compensating with Teladoc stock, they could compensate them with Amazon stock, which is far more resilient to stock-based compensation. Certainly $51 million on a $1 trillion company is basically pennies, whereas $51 million on a $4 billion company is a significant amount. That is your upside with this one, and that is your protection to the downside, that at some point this one becomes an M&A target and you get a bid on this stock and it kind of pops it up. That would be the time to sell. But like all of these stocks, I would limit your losses with these. These are high risk, high reward stocks. The way you mitigate that is by taking less risk on this stock, taking just a 4 or 5% loss with the opportunity to get maybe something like a 50% gain on this one. Because I think if we were to get taken out in the shorter term, you'd look at a company with maybe a 10 to 20% premium. That would take you up into as high as maybe a $7 billion, $8 billion valuation. That certainly would be a nice premium in the shorter term. That was Teladoc Health. We'll certainly cover this stock on their next earnings call. Interesting one, if I say so myself. Now, moving over to our next stock, I don't think I did an earnings video on this stock. And I would say Roblox out of this 4 stocks is probably the one that is still what I would consider wildly overvalued. This one still has a $23 billion valuation. And over the last year, this one's down 51%, year to date down 60%. But there are some catalysts with this stock that make me a little excited. First of all, you get kind of estimates from this company virtually every month. They kind of give you an update on their estimated bookings. You get an estimate on revenue. You get an estimate on users. So you can kind of keep close tabs on this company, but it will create some volatility if those numbers don't come in line with what expectations were. Well, you see these pretty large drops in this stock after news like this runs. So this is, out of all of these stocks, out of these 4 stocks, this is the highest risk stock in my opinion, because you still have a very elevated valuation, and the fact that when they announce these kind of monthly numbers, it can bounce around quite a bit. Now, this company does have a tailwind though, in the fact that they haven't really rolled out advertising. And that certainly is the play that Meta or Facebook is planning on with their metaverse products, is that they're going to roll these things out, get a bunch of users, and then they're going to get a bunch of advertising kind of layered on top of there. Different types of experiences, different types of advertisers will certainly kind of pour in and at the very least test ads on these types of things. Again, if the Roblox kind of demographic meets with the target audience that they are trying to reach. And typically with a Roblox, it's kind of that top of the funnel advertisers, the McDonald's, the Disneys, and the companies that are trying, maybe like the PepsiCos, that are trying to just do just a big, like wide swath of advertising, not necessarily trying to generate a dollar off of every dollar in advertising. They're just doing these broad brand advertising like a Nike or again, like a PepsiCo or a McDonald's. Now, iHeartMedia is the latest to shut up their shop inside Roblox Metaverse. So you have all these different brands, which could create it like similar to like a website or like an app on your phone. It's believed that Roblox could turn into that, where they're almost like an app store inside their game. There's certainly advertising on that. It could be like an e-commerce platform as well. There's a lot of things that you could dream. Now, you obviously have to dream at a $23 billion valuation on this company. You've got to dream that they hit a home run on a lot of those things. That's why the risk on this one's still probably a little too great for my taste, but I still want to cover this stock because if they do hit a home run with a lot of this stuff, and Roblox is this kind of transformable game into the future when it comes to the metaverse, well, this stock at $23 billion could maybe become a $200 billion stock. And look, you 10x your money on a stock like this, it'll be one of the greatest investments that you've made in your entire life. Now, this company recognized revenue in the most recent quarter, so they reported these earnings back on August 9th, so we shouldn't have earnings for this company for a little while, but August 9th came in at $591 million worth of revenue. That was 30% growth. I tell you what, if you grow at 30%, you're basically doubling your business every 2.5 years. That rule of 72, if you take 72 and you divide it by 30, that's essentially how many years it takes to double your money. So that's why we pay a large amount of attention to growth rate here on the channel, because if you have that mid 20 to 30% growth rate, you are doubling your business very quickly. We'll look at analyst estimates here in a minute, but the point I want to make is that even on revenue of 591 in a quarter, you still have to remind yourself you got a $23 billion valuation on this one. We'll take a closer look at the numbers here in a second, but I do want to look at analyst estimates, and they have been peeled back tremendously over the last year or so. Look at our revenue growth for the upcoming quarter, just expected to grow 7.25%. And then it's expected to accelerate into next year, kind of a mid-teens grower. And then you have kind of a bearish analyst, one bearish analyst that's really projecting out 2 years. And they're actually projecting the revenues to actually decline year over year based on the midpoint guidance. So this is a company with a premium valuation. It doesn't make money, which I'll show you here in a second. And the growth rate doesn't check that box. So this one, in my opinion, still wildly speculative and one I'm not as excited about as the rest of these companies. Here's your revenue, 454 up to this 591. Again, that was about 30% growth. If they could maintain a 30% growth rate, this might be a stock that is worth the gamble. But again, I just showed you the analyst estimates when it came to this one. They're expected to slow down to a mid-teens grower, and that's probably on the high end. That is worrisome to me. So a lot of these other things like the ads and the individual shops that are set up inside this universe, well, those are really going to have to accelerate, and those are going to have to really do well for those individual advertisers for this company to maintain this type of growth. Now, off of $591 million worth of revenue, unfortunately, you had $761 million worth of costs and expenses. So your loss from operation accelerated from 142 up to 170. So unlike Palantir, unlike Teladoc, this company is actually not at the turning point of profitability. So that's a problem as well when it comes to this company. From a balance sheet and cash flow perspective, it's about what you'd expect from a company of this size. My guess is they're going to have to continue to raise money. That's probably going to lead to dilution. Now, what actually is kind of exciting about this company is this technical chart pattern. Obviously, this stock, like a lot of stocks, has just been in free fall mode since late last year. November 2021 is when a lot of stocks started peaking, and we've seen this one just absolutely fall off a cliff. It was up over here of $140 per share, peeled off over $100, bottomed out at about $24 per share. But what's more exciting is we are making a very steep set of higher lows on this one. People are loving this stock at higher prices. Made lows back here in May, made a higher set of lows in June, made another group here in September. If this area holds, and it should, if this technical pattern holds, it should show signs of this next week. So you should at the very least, kind of hesitate and hold this price next week. If you get strong market reaction next week, a speculative stock like this could rally up and make another set of higher highs. That would take you from $39 all the way up to $55 per share on the high end. That is $15 upside. I tell you what, you could make a shorter term trade on this one, where I would put a stop loss at the lows that we made back here at September at about we'll call that $35 per share. So you're risking $4 to the downside to make $15 to the upside. If you learn anything from me on today's show, if you're going to make a speculative bet and a speculative trade, that is the risk reward you're looking for. You're looking at like a 3, 4, 5 to 1 type spread where you're losing 3, but you're gaining 15. If you're successful enough with those types of trades, you can be a very successful investor, and certainly from a shorter term perspective. From a longer term perspective, I think this stock is still wildly overvalued. It wouldn't be a stock that I'm into right now. I think this company is going to raise money that is going to put pressure on the stock. This is an interesting stock from the case of Meta as well, or Facebook, and the fact that if this company can gain a lot of traction, you got to assume Meta, with all of its cash and its cash flows and its large base of users, certainly could catch the metaverse as well as Roblox. So that was Roblox. The last stock that we're going to look at on today's show is DraftKings. Now, obviously, this stock, if you watch football this weekend or watch any kind of sports, this stock just spends a ton of money on advertising. We'll certainly see evidence of that when we get over to this company's financials. You'll see this company spends a lot of money. And unlike Palantir and unlike Teladoc, but just like Roblox, this stock is actually, in my opinion, probably still a ways away from earning a profit. Now, year to date, down 33%. Over the last year, down 68%. Still got a pretty steep valuation on this one. Still sitting at about $8.3 billion despite that rapid decline. Now, we come over here to the earnings estimates. The thing that separates this stock is its gigantic revenue growth. Look at this. Analysts are expecting in this upcoming quarter to grow 100%, over 100%. Over the last year to $432 million worth of revenue. We'll come over here and see how that compares to the most recent quarter as well. For the Q4, you're expecting $816 million worth of revenue. Again, that's a Q4 that includes the NFL football season. I think World Cup is this year as well. Probably will get a boost, quite a bit of boost from that as well. So you've got some major sporting events over the tail half of this year, which should be a tailwind for this company. Expected to grow 72%. But look, even out into the next couple of quarters, you're at least at like a 19-20% growth rate. And some analysts have this one as high as like 30% in the subsequent quarters. When you look at this from an annual perspective, and I always like to do that because it just makes a little more sense from a price to sales perspective. This year, you're looking at about $2 billion. You're right around 4 times sales on this one. If you're to achieve 32% growth next year, you'd be at about $2.8 billion over at DraftKings. That's about a 3 times forward sales. If you're really looking out into the future with DraftKings, which quite frankly, I really think you need to do, well, this company might get south of 1 time sales. But what I would caution you in saying, well, I'm going to buy it today, and in the future, it's going to be 1 time sales. Well, what you don't factor in here is the dilution and the fundraising that is going to be required to get to $8.5 billion. This company is going to have to continue to issue shares, not only from a stock-based compensation perspective, but I think to raise money as well. Because when we come over here and look at this stock, it's not very good from a financial perspective. You see revenue in the most recent quarter coming in at 466, but your total expenses, they don't give us a total here, unfortunately, because this is consolidated, but just your cost of revenues over at DraftKings are $312 million. So off this 466, you have cost of revenues at 312. This doesn't put this stock in a very exciting light for me. It's not like a Palantir that has really high gross margins, let alone the other software stocks that we're looking at. And then when you layer on the fact that you have sales and marketing coming in at 197, I mean, just your sales and marketing and your cost of revenues is north of $500 million. And again, I showed you the revenue estimates, and we'll come back and look at it from a quarterly perspective outside of the fourth quarter when you have the NFL and potentially like big soccer matches. This company is not doing much over $600 million in a quarter. And so that is a problem when your cost of revenue and your sales and marketing is in excess of your revenue in most decent quarters. So you can expect when we get to these fourth quarters that just have massive revenue growth, well, it's going to be offset by the fact that the cost of revenue and the marketing spend in those quarters is going to be rather large as well. Now you have product and development costs as well. That came in at $77 million. And then finally you have general administrative expenses coming in almost as high as your marketing costs at $187 million. So off of $466 million worth of revenue, you made just $308 million. That is not, I repeat, not good enough. And the reason why that is not good enough is you come over here and look at your asset side, you have just $1.5 billion worth of cash. At the beginning of the year, you had $2.1 billion worth of cash. So they've shed off over basically $600 million worth of expenses. That's just in 6 months. So I would expect over the next 6 months, you're probably going to peel off at least another $600 million. That means this company has barely 1 year of cash to survive. And if you're at just 1 year of cash to survive, that means you're going to be raising money in the next probably 3 months. In fact, I can't believe this company hasn't raised money yet. From a cash flow perspective, you see it here as well. This paints a really, really bad story. Net loss at this company was $684 million. That was for 6 months. Now they do get to add back in depreciation. They add back in stock-based compensation, but you come down here to cash flow from operating activities. This is a major problem. They burn through $530 million of straight cash. This is not stock-based compensation. compensation. This is not fantasy money. This is real money that they burn through. Notice last year on a 6-month basis, they burned through just $176 million. So they are lighting money on fire over at DraftKings. Again, for 6 months, they burned through $529 million worth of cash, and they have just $1.5 billion worth of cash on the balance sheet. This is a company that is going to need to fundraise, quite frankly, as of yesterday. Now, from a technical perspective, it's looking like a lot of these stocks that are making a series of higher lows over the last couple months. Believe it or not, I know a lot of people looked at last week on the stock market and they wanted to crawl up in a little ball and go cuddle up next to Jerome Powell for the next 6 months. No, stocks like DraftKings, stocks like Roblox, stocks like Teladoc, and stocks like Palantir are making higher lows and looking like, if the momentum can stay in that direction, are actually reversing and are ready to go higher. DraftKings should have significant resistance here at about $19 per share, essentially where the stock is at the current day. Current price is about $18.60. That should be some heavy resistance on this stock. Wouldn't be an area where I would buy, whereas we looked at the other stocks in this group. Some of them are setting up a lot better from a technical perspective. Now, if DraftKings can burst up over $19, maybe get up here to $23, there should be a level of resistance here, but that should be met with some kind of pullback, okay? You should get a pullback on this one, probably back to the $16.50, maybe as low as down here to $15. Again, depending on how fast that happens. But if you can set up on higher lows, that would just confirm that you're making higher lows, higher highs. I'd want it to get confirmed, though, higher highs. I actually think DraftKings needs to go from 20 to 23 over the next, look, it could be over a quarter. It could be over the next couple of months. It doesn't really matter. But you need to get over this group of highs. Then you will have made higher highs all along here. You will be setting up a pattern like this. I think you get rejected at 23, 24. Investors are going to be disappointed. I think some investors that don't come over here and read these financials and kind of see the clear read on these types of things, they're not going to realize that this company is not going to make money this NFL season. The World Cup is not going to help profits over at this company. It's just going to continue to the cost that this company realizes. And the stock is probably going to fundraise. So they're going to do a following offering where they issue either debt, or they issue maybe debt in combination with some kind of convertible note, or they just come on and just sell the shares. That is going to put pressure on the stock. You're going to have a pullback. That would be the area where I would be interested on this one. I think you're going to be able to get another opportunity south of where the stock is today at about $18 per share. I think at the very least, you're going to be able to come back down to $15, $16 per share, depending on how that fundraising goes. In my opinion, from an investor standpoint, the more they can fundraise, the better. But the more that DraftKings fundraise, the more it's going to dilute you and the more pressure it's going to keep on the stock. So it's going to be a catch-22 when DraftKings fundraises. They need to fundraise, in my opinion, several billions of dollars, but that is very hard to do on a stock that is just worth $8 billion. That is why we go back to our original point. You have to take profits on these stocks. They are not buy and hold stocks, especially in the case of DraftKings, and I would say Roblox as well. These are companies that when their stocks go up in price, they will immediately sell them to raise money. That is what this company needs to do. That's why if you can generate some short-term profits on this one, I would not at all hesitate to take profits. Folks, that was our hype stock sector show today. We'll certainly come back later this week with more. We'll see how these markets react. If they have a week like last week and they have these gigantic pullbacks, that is just going to create a lot of opportunities to step in here and buy. If you've been following this channel any length of time, you know I did not do a lot of videos where I was talking about buying stocks back in 2020 and 2021. That was when the crazy people that were on unemployment opened up a Robinhood account and started trading stocks like they were a boss. That was when you actually sold stocks, or you at the very least took a pause. When stocks are down 60, 70, 80%, and they've taken a bath and they continue to look like things are going to get negative, that is when you get excited. That is when you go into stocks, not when things are good. That is when the amateur and the newbie actually piles into stocks. They pile in at the top and then they dump them at the bottom. The professional, the real investors buy when things are ugly. They buy in the presence of bears. In fact, you might be in a cave hibernating with 4 or 5 bears. that is when you acquire stocks. You acquire stocks when people think it's just going to go lower and lower and lower, and the world is going to end, and economies are going to end, and everything's going to become a disaster. That is when you acquire stocks. I bought stocks in 2008, I bought stocks in 2009, and I bought stocks in 2010, and 5 or 6 years later, I bought the very house that I'm sitting in today, and gosh, I could sell this house that I live in right now for a boatload of money. And I wouldn't be sitting here today if I didn't make those hard decisions in 2008 and 2009 when everybody thought I was crazy to get into that stock market. You got to be a little crazy to buy at the bottom, but if you're a little crazy, you're probably going to be a lot rich into the future. Hopefully you guys enjoyed today's video. I'll be back again soon with more. Enjoy football and whatever you decide to watch today. Good luck with your investments.